Good morning, everybody. My name is Joe Warther, and I'm senior lecturer here at Georgia Southwestern State University. And I want to talk to you a little bit this morning about Chapter 15. We're going to just talk about the chapter, and I'm going to summarize what I think is important and show you a little diagram to explain, the flow of cost that you kind of got acclimated to in Chapter 14. Now, before I get started with Chapter 15, you want to go back to Chapter 14, and you want to make sure now that you know your production cost, and particularly that you know what your manufacturing overhead costs are. And we can just label them right here. The ones that I am really familiar with are indirect materials, indirect labor, depreciation on plant equipment, rent of the plant facilities, taxes in the plant, supplies used in the plant, any cost, janitorial services in the plant, maintenance services in the plant, supervision in the plant. These are all overhead costs. And I always tell the students that any cost that you see the word plant or factory associated with, if it's not direct, if it's not a direct material, in other words, it's not associated directly with the product, and direct materials and direct labor are associated directly with the product. Well, if it's not one of those two, and it's got the word plant or factory, it's got to be overhead. Now, I don't know if we talked about the difference between product cost and period cost. Product cost, of course, are direct materials, direct labor, and manufacturing overhead. And period costs are such costs as selling and administrative expenses, operation expenses that are associated with the administrative part of the company. Any expense that's not related to the product, that's not in the plant, is a period expense. And period expenses are deducted on the income statement for that particular period. Whereas product costs or product expenses are bundled up and they are associated with the asset finished goods inventory. And finished goods inventory will sit in the warehouse until it gets sold. So essentially, finished goods inventory is an asset until it gets sold, and then when it gets sold, it becomes an expense. Cost of goods sold, that's your biggest expense on the income statement. So that's the difference between period cost and product cost, which is very important to know, because there will be questions on the exam talking about period cost and product cost, and asking you to label manufacturing overhead cost and period costs separately. So in your exercises and problems in the book, do that for you. Now, as far as Chapter 15 goes, first thing you got to know is the difference between a job order cost system and a process cost system. And that's at the beginning of the chapter. I'm going to ask you specific examples of each. A job order cost system, just remember, each job is separate, each job is different. A process cost system, the whole job is the same, such as the refining of gasoline. It's all the same. The costs that are associated, that attach themselves to the refining process, are all the same costs. Well, whereas with a job order cost system, you may have one set of costs for one operation, and for the next operation, you may have a whole different set of costs. It may cost more, cost less. Okay, so that's the big difference. Read that at the beginning of the chapter. Read those pages. The difference between a job order cost system and a process costing system. Now, the rest of the chapter is pretty much a a continuation of chapter 14. We talk about the product cost, and we talk about the three inventory accounts, raw materials, work in process, and finished goods. But here now we're going to apply those product costs to a specific job, and that's the big difference. Now we have a specific job going on in the plant, and we're going to apply raw materials, direct labor, and manufacturing overhead. We're going to allocate those costs to the job, and when the job's finished, the job is going to flow out of work in process into finished goods, and it's going to sit in finished goods until it gets sold. And when it gets sold, it's going to flow out of finished goods, and it's going to flow into cost of goods sold. Now, let me just show you a little diagram here, and I don't know if you can see this or not, but this diagram is on page 815 in your book, and it shows you the flow of costs. Maybe if I turn this light off, you can see it better. It shows you the flow of cost, raw materials, direct labor, and applied overhead. Okay, and we're going to talk a little bit about applied overhead. Those are the three costs that flow into work in process. Now, in this chapter, you have a new account that we introduce, and that new account is manufacturing overhead. And the best way to do this is just like they do on page 815. Make yourself some T accounts, and you can trace the flow of costs a lot easier using T accounts. Now, with the manufacturing overhead account, what you got to remember is on the left side, or the debit side of that account, you put all the actual overhead costs. Okay? So anything that's an actual overhead cost that comes in gets debited to manufacturing overhead. Okay? So that's the first thing you got to remember. Now, if you look at page 810, we, in this chapter, develop what's called a predetermined overhead rate. Okay, and this is what's different from chapter 14 compared to chapter 15. In chapter 14, we just took the overhead and we just put it all in work in process, and away we went. Well, accountants decided about 25 years ago that it would be better at the beginning of the accounting period to develop a rate and use that rate to apply overhead instead of just waiting on the actual overhead cost. See, because what happens is when we start a job in January, let's say, and we want to get that, let's say we finish that job, we start the job January 1st and we finish it January 10th, and we want to get that job out into finished goods inventory, and we want to sell that job. Well, we can't wait around till the end of the month till a lot of actual overhead costs come in so that we can apply those actual overhead costs to the job. We can't wait on that. We're on a schedule. We're doing job after job, and we finish this job January 5th, and we want to get it costed, get all the cost into the job, and we want to get it over into finished goods. So what we do is we put together what's called a predetermined overhead rate, and we look in the past, and we take the past overhead, the total overhead for the year, and we put that as the numerator, and then we look at what our activity was for the past year, and we can either use direct labor hours, machine hours, or our direct labor costs. for the past year. We can use one of those three as what I call the base or the denominator. So to develop the rate, it's the estimated overhead, okay, which is actually the past actual overhead as the numerator, and it's the over the estimated base, which, like I said, the base can be direct labor hours, machine hours, or direct labor cost, and it's all from the past, but we call it estimated because we're estimating it for this coming year. And what we do is we take that ratio and we get a rate. And what you got to remember is, with that rate now, if let's say you used direct labor hours as your base, then you got to go look for that job that you just finished, and you got to go look for those actual direct labor hours that you used on that job. And you take that predetermined overhead rate that you developed and you multiply it times those actual direct labor hours that you just used on that job, and you get what we called applied overhead. Applied overhead. Okay? And once you get this number, this applied overhead number, you credit the manufacturing overhead account. Okay, so remember, the debit side had the actual overheads that you were accumulating for this period, and now the credit will have an applied overhead number that you just calculated. Okay, so you credit manufacturing overhead, and then you go over and you debit work in process. And so what you're doing is you're applying overhead or allocating overhead to the work in process account. So the work in process account will have the actual direct materials, the actual direct labor, and the applied overhead. That's what the work in process account will have. And then when the job finishes, those three costs are summed up, and you credit work in process, and you debit finished goods. And those three costs, the sum of those three costs, sit in finished goods until you sell the job. And once you sell the job, you credit finished goods, and you debit cost of goods sold. And that's how it works. It goes from work in process to finished goods to cost of goods sold. The job gets worked on in work in process, and when it gets finished, it moves over to finished goods, and when it gets sold, it moves over to cost of goods sold. Now, there's one last thing you got to do, okay? And that's on page 820 in the book. At the end of the accounting period, and let's say it's the end of January, because usually we close the books on a month-by-month basis. At the end of the accounting period, you got to compare the actual side, the left side of the manufacturing overhead account, which are the actual overheads that you've accumulated for the entire month. You got to compare that total number to the amount that you applied on the right side. Now, let's just use an example. Let's say on the left side the actual number is 100, and on the right side you applied $75 or 75. Okay, what you did here is you under applied too little overhead to your job, because you should have applied $100, but you didn't. You applied 75. So you're $25 short of costs on that job, because you should apply theoretically what the actual overhead costs were, but you didn't, because you wanted to get the job finished and get it over to finished goods, and you want to sell the job. So you develop the predetermined overhead rate and you applied overhead, but at the end of the accounting period, you find out that you didn't apply enough overhead. You should have applied $100 of overhead and you didn't do it. So you underapplied your overhead by $25. Well, what you have to do is balance the account, okay? Add the 25 to the right side of the account, which is the credit side of manufacturing overhead, okay? And that zeroes it out because both sides now are the same. And since you credited manufacturing overhead with $25, you go over to cost of goods sold and you debit cost of goods sold for $25 more. What that does is put $25 more worth of cost into cost of goods sold. So now when you sell that product, as that product moves over to cost of goods sold, you will have a true cost now. It'll have the true amount of overhead in the total cost, and you will be able to see exactly the gross margin that you made on that sale. Remember, sales minus cost of goods sold is gross margin. That's Accounting 2101. Okay, and you will use that a lot in this course. So basically what you need to do is you need to go through this chapter. The important pages are page 810. Okay, that's where you develop the rate. Pages 815 shows you the flow using T-account analysis, and that's the easiest way to see the flow. And then page 820 will show you the under applied overhead, the ending journal entry you have to make. You're either going to increase cost of goods sold by debiting cost of goods sold, or you're going to decrease cost of goods sold by crediting cost of goods sold. So with that, to me, those are the three most important pages in the chapter that you need to study, because like I said in the beginning, the chapter is kind of an extension of chapter 14. You know, you got to know your three product costs. You got to know what makes up overhead. You got to know the costs that make up overhead. If you don't know, go back to chapter 14. There's some pages. I know there's one page in particular, or a paragraph, that tells you exactly what make up overhead costs. And you got to know that there's three inventory accounts: raw materials, finished goods, and work in process. And then in chapter 15 we have a new account, manufacturing overhead, and it's just a temporary account that, remember, it houses on the debit side, which is the left side. That's where you place all the actual overhead costs, and on the right side, the credit side, is where you put the applied overhead that you figure out using your predetermined overhead rate. Now I'm going to try to illustrate a problem in the book with a later video, but this is just a summarization of the chapter. But stay tuned for a later video that I'm going to do before the exam takes place. I'll illustrate a problem in the book. Now, you have the solutions out there to all the problems in the book. So the problems in the exercises. So it's up to you now. When doing Wiley Plus, they'll be the same problems as what's in the book. They'll just be using a little bit different numbers, but you will be able to go to the book and look at the solution, and you should be able to figure out the problem in Wiley Plus, even using different numbers. Thank you very much, and I will get together another video illustrating a problem in the book to explain the flow of costs before the exam. Thank you very much.